Moving up to the high risk mutual funds class, we have index funds or exchange traded funds. And index or exchange traded funds are designed to follow certain preset rules so that the fund can track a specified basket of underlying investments or index. So we learned what an index was already in the previous videos, and an index mutual fund is a basket of securities that would represent the index. You can't invest in an index itself, but you can invest in an index fund or exchange traded fund or ETF. The two investments are very similar in that they represent a basket of securities that would track an index. And the main difference being that an ETF can be traded at any time, where an index fund is only traded at the end of the day using the closing prices. So you can imagine the intraday price swings of an index wouldn't be captured in an index fund, but would be with an ETF. And a couple examples would be the Vanguard Total Bond Market Index Fund, or the Vanguard Total Stock Market Index Fund, or the Vanguard Total Bond Market ETF, or the Vanguard Total Stock Market ETF. Next would be growth funds, and not shown in this illustration, but are in the level of risk as well. And growth funds are a diversified portfolio of stocks that has capital appreciation as its primary goal, with little or no dividend payouts. The growth fund portfolio mainly consists of companies with above average growth that reinvest their earnings into expansion, acquisitions, or research and development. A couple of mutual fund examples for growth funds are the Vanguard Growth Index and the Fidelity Growth Company. Value funds are also not shown in this illustration, but are in this level of risk as well. And value funds seek to invest in stocks that are deemed to be undervalued in price based on fundamental characteristics. Value investing is often contrasted with growth investing, which focuses on emerging companies with high growth prospects. So some value mutual fund examples are Fidelity Blue Chip Value or the Pinnacle Value Fund. On average, these funds are considered high risk mutual funds and can provide an annual return ranging from 6 to 10%. The highest level of risk for a mutual fund class is the aggressive risk level, and that is where the stock or equity mutual funds exist. So equity or stock funds invest principally in stocks. It can be actively or passively, index fund managed. This would be the most practical type of fund that would be closest in performance to investing in single companies. And the biggest difference would be that the equity fund could have 10 to 100 companies within the mutual fund, and diversification across multiple mutual funds would expose you to like thousands of companies, where diversification in the stock market would be more like 10 to 20 companies max. Global funds are also in the aggressive risk class. And global funds are a fund that invests in companies located anywhere in the world, including the investor's own country. A global mutual fund would be how you would invest internationally in other stock markets without the risk or fear of knowing what you're doing investing in other companies. A couple examples of global funds would be Vanguard Global Wellington Fund or Delaware Global Listed Real Assets Fund. Emerging market funds invest in companies from countries and regions where markets are developing, and these funds may have specific concentration in some large or fast-growing economies in the world. Perhaps you may have a McKinsey Emerging Markets Fund or a Schwab Emerging Markets Equity ETF. We're getting more specific as the risk goes up, so naturally you can also get into sector or specialty mutual funds. And sector or specialty mutual funds are investment funds that invest solely in businesses that operate in a particular industry or sector of the economy. Think maybe Schwab Healthcare Fund or Fidelity Wireless Portfolio. We're getting pretty specific now. On average, these funds are considered the highest risk mutual funds and can provide an annual return from anywhere from 8 to 12%.